So we are now starting chapter 16, which is capital structure decisions. So first the very basics, what do we mean by capital structure? Yeah, exactly. So your capital structure is basically saying your capital or the money that you've raised, where have you raised it from? So is it, if I say my capital structure is 50% debt and 50% equity, am I describing a capital structure here? Yeah, I'm describing a very simple capital structure. So what's my debt to equity ratio? 1. Okay. So I hope you figured this out after the last exam. Debt to equity ratio is 1. The debt to total capital ratio is 1 over 0.5 over 1, which is 0.5. Okay. So that's your capital structure. What is a target capital structure? Is it conceivable that my current capital structure is 50% debt, 50% equity, but my target is to reduce debt to 25%, increase equity to 75%? So that is my target capital structure. You've seen this in the chapter on WACC. Does debt impact the value of the firm? So in other words, depending on simply changes to my capital structure and not impacting my operations in any way, can I change the value of the firm? Okay, so that is the question that we are going to fundamentally address in this chapter. So one basic point is debt increases cost of equity. Why is that? Asking you, why do you think having more debt increases the cost of equity? कोशिश तो करें यार. Why do you think, so just think about it for a second. So a company has 50% debt, 50% equity, okay, and you are thinking of buying shares in this company. Now the company announces that they are going to cut down equity and increase debt to 80%. Is the share becoming more risky? Yeah, it's becoming more risky. Whether it's attractive or not depends on how much you are attracted to risk. Okay, so right, so it's relative. Okay, so clearly what is clearly true is by taking on more debt, a firm is becoming more risky. Okay, when a firm becomes more risky, then what is the cost? What's happening to the cost of equity? If the firm is becoming more risky, then investors need to be given a higher return. So the cost of equity is going up. So these are just some basic remarks from before that I am highlighting. Okay. Debt reduces taxes. Why is this your name in the middle? Next to, why does debt reduce taxes? Exactly. So when you take on more debt, then interest payments become higher. That means earnings before tax become lower and taxes become lower. So do you notice just at a high level that as you increase debt, there are two opposite impacts taking place. On the one hand, your cost of equity and hence so the cost of equity or the riskiness is going up. Is that good or bad? That's bad. On the other hand, your taxes are coming down. Is that good or bad? That's good. So one good thing is happening and one bad thing is happening. So a lot of this reading will be around figuring out whether more of the good thing is happening or more of the bad thing is happening. Or maybe it's a balance. Okay, so those are the three scenarios. If they are in balance, then what do you think will happen to the value of a firm if we keep increasing debt? If the good and bad are in balance, then the value will not change. All right, and if the good outweighs the bad, value will increase, and the third is obvious enough that it will remain unstated. Okay, so now let's understand this through a very simplistic example. So say you have two hypothetical firms, firm U and firm L. Firm U is an unlevered firm. What do you think that means? No debt. And firm L is a levered firm, which means that it has debt. Okay, both companies are similar in that they have $20,000 worth of assets. Okay, and both have the same tax rate. Firm L has 50% debt, where it needs to pay a 12% interest on debt. Okay, is this picture simple enough? Okay, can you understand why we are going to study this example? So we are going to look at the impact of, so what's the capital structure of firm U, Amit? 100% exactly. And next to Amit is Malik. What is the capital structure for L? 50%. Yeah. 50% debt, 50% equity. So we are going to see, okay, so, Waqar is making a profound statement. Okay, what is your statement? Okay, all right. Okay, so anyway, so this is 20,000 in assets. So 10,000 is debt. So equity is, Waqar? Equity is also 10,000. So 50% of debt, 50% of equity. Both firms have same operating leverage, the same business risk, and EBIT of 3,000. Okay, so do you think leverage or the capital structure will have an impact on EBIT? So what does EBIT stand for? So say it. It won't. Okay, it will not, because the earnings before interest and taxes. So since it's the earnings before interest, then obviously whether you are paying interest or not, whether you are paying taxes or not, has not been factored in yet. Okay, and what are the two things that are impacted when you do have debt? Then A, there is interest, B, the interest is different and the taxes are different. So if you are going with operating profit, which is before interest and taxes, then it should not matter. So and can we say that the operating profit is a function of the pure business operation of the company? Because operating profit would be, okay, what are my sales minus what are my various business operating expenses? It does not depend on tax rates, it does not depend on interest rates and so on. Okay, so we still have, so both companies have the same EBIT. So the only difference between the two companies is with respect to the use of debt. Now let's look at the impact of leverage. For firm U and firm L, EBIT is the same, right? Interest for firm U is 0 and for firm L is, do you know where this came from, Waqar? Where did this 1,200 interest come from? 12%. Exactly. So this was the 12% of the 12,000 of the 10,000 debt. Okay, EBT. So where is this coming from? This is earnings before taxes. Firm U has 3,000, firm L has 1,800. So taxes are higher for firm U. Does that surprise you? Yes. It does? Why does it surprise you? Oh, it's obvious. Okay. All right. All right. So anyway, these two pictures should be obvious. Okay. Why do we have a ROE that is higher for the leveraged firm? Yeah. So the reason is, even though, notice the net income of, does it make sense that net income for firm L is lower? The net income is lower because it also needs to pay out interest. So firm L is paying interest. Okay, the taxes come down, but not by 1,200. So the net income for firm L is actually low compared to firm U. So Manoj, why then is the ROE for firm L higher, even though the income is low? Exactly. The equity for L is only half of this. So the equity, what is the equity for firm L? So if I put to another, so equity for L was 10,000 and U was 20,000. So in this particular case, if you are the equity holder, you borrowed 10,000, then you are paying off the interest, and even though you have paid off the interest, you still have a net income of 1080. So against your equity, you are making a higher return. Okay, now just looking at this, why wouldn't everybody just go leveraged then if you are making a higher return on your equity? So Samra? Yeah, why? Where are we making a higher return on equity, in the leveraged situation or the unleveraged situation? So why wouldn't everybody just go leveraged then, as opposed to going for an unlevered? Okay, I want a very simple, basic example. Okay, Torab, yeah, depends on your. Okay, no, so
It depends on priorities.
for example, yeah, okay, so I can.
Capital structure is like, what are the need?
Okay, I'll give you two really basic answers for why everybody doesn't go with leveraged. One basic reason might be you might think that interest is haram. Okay, so that might be one reason. The other, maybe you don't have a moral or an ethical issue with interest, but clearly firm L is becoming more risky, which was alluded to. How is it more risky? Because you, in this year you made EBIT of 3,000. What if next year there is a downturn in the economy and your EBIT is only 1,000? Will the bank from whom you borrowed 10,000 say, don't worry, it's a bad year, forget, don't pay me my 12,000? They will not. Interest has to be paid no matter what the state of the economy. Yeah, which is so then you still have the 12,000 due. Okay, whereas for firm U, he does not have to go pay the bank 12,000. So clearly, in a downturn, the owner of firm U will sleep easy, whereas the owner of firm L will have sleepless nights. Okay, because he still has an obligation regardless of the fact that his EBIT was low. Okay, so what I'm just planting the hook here is that clearly you can see already that the riskiness of firm L is more. Okay, now why does leverage increase returns? The total return, in the case of the unlevered firm, your net income is 1,800. Let's say that who are your investors for firm L? How have we defined investors throughout? Shareholders and debt holders. Okay. So how much money do the investors get with firm U? The only investor is the shareholder, and they get 1,800. With firm L, who are the investors? And what's the total money that? 2280. So how is it that simply by changing the capital structure, the investors in the levered firm end up making 480 more than the investors in the unlevered firm because of the tax savings? So when a company makes money, broadly speaking, three entities get a share of that money. The three entities are the shareholders. Actually, so there's the shareholders, the government, and the debt holders. Who gets money first? Yeah, first the debt holders get their money, then the government, and then the shareholders. Okay, by paying the debt holders first in the levered scenario, what have we done? We have reduced the amount that we need to pay the government, i.e. we have reduced taxes. So this indicates a benefit of leverage, where you have managed to reduce the money that goes to the government. Okay, so more EBIT goes to investors in firm L. Okay, we'll stop over here and